following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. We thank you for joining us today on 94.1 FM WNBU as well as cable TV 10 in New Bern. We got Bob Register on the board mixing the show for us. And some of you may be watching on the internet. We welcome you as well on from our website, www.dlblain.com. And we like to get input from you, our viewers and listeners. So if you have comments or questions of the show, topics you'd like us to talk about, please give us a call. Our number is 252-633-0107. You can also email me here at the show, which is allthingsmoney@dlblain.com. And you can always visit our website, www.dlblain.com. There you'll find information about myself, my firm. We are a registered investment advisor providing fee-only wealth planning and investment management for people all across the country. And we would love to hear from you or have you come check out our website. I got a couple of good topics for today. I think we'll start off with high yield. You know, today the number one question we're getting, and it's just so funny, it's not funny, but from where I sit and we see the sort of concerns of clients and they kind of go in these ebbs and flows and you can kind of pick up on what's going on in the media without even watching TV, just by the questions people are asking. And so the biggest thing today is, well, let's kind of roll back. You know, during 2008, the big question was, you know, should we invest in stocks ever again? I mean, they went down, 48, 50%. You know, why should we ever invest in stocks again? And then, of course, we've had this bull markets hitting new highs. Then we heard, well, the efficient market hypothesis is dead because stocks went down, and so did foreign stocks went down at the same time as U.S. stocks. That was like totally unexpected to people. But if you're a student of the markets and the way things work, you would have that was not a surprise at all. And of course, now the big thing is: should we invest in fixed income at all? Bonds? Should we invest in bonds at all? And a lot of this stems out of the past, say, maybe 2 months, where we had yield on the 10-year Treasury at about 1.5. Its low was 1.4 back in July of 2012, and today we see the 10-year yield up around 2.5%. But even as late as May, we saw the yield at 1.5 or so, 1.6. And it jumped up to 2.5. Now, for those of you that invest in fixed income, you know what this means. It means that the value of the bonds or bond funds or ETFs that you have went down. And it went down to the tune of numbers that you may not have ever seen before. The Barclays Aggregate Bond Index, which tracks the U.S. bond market, had its worst quarter, I think, since 1987 or something like that. And so people that invested in these bonds, the conservative investors, supposed to provide downside protection, really got kind of a wake-up call. And, one comment I just kind of start off with is that, as I say all the time, investing, and you see it printed everywhere, is investing involves risk. And that the risk is you have to endure some volatility in the markets. If you're investing in a diversified portfolio, the likelihood that they're going to go to zero is unlikely. And so what people have done is they've taken, say, a U.S. Treasury bond that went down by a couple of percent, and they're extrapolating that and say, oh, no, it's going to be worthless. Well, that's not quite the case at all, and we think the panic is overdone. Even the world's largest bond manager, Bill Gross, there was a great article in the Wall Street Journal yesterday about Bill Gross, who runs the PIMCO funds, bond funds. He's called the bond king. Even he lost a couple of percent the past quarter. It's just the nature of investing. It's going to happen. You're not always going to have positive quarter after positive quarter. Well, anyway, so back to the fixed income. So the yields have been very low, and what we saw was people that had been chasing the yield got hurt even worse. The high yield bonds, emerging market bonds, things like that. And so what we want to do is talk about today a little bit about the alternative people investing in things that pay a higher yield. We prefer people approach things from a total return basis. And just looking at, for example, the stock market, if you have a good mix of stocks and bonds, instead of investing for that 2, 3, 4% yield from the portfolio, which by the way is very tax inefficient, it's another topic, tax at ordinary income rates. We advocate investing in a diversified portfolio for a total return. So the total return of, say, a 60-40 equity growth type assets and income type assets the past 12 months, I was just looking at it yesterday, not to cherry pick those 12 months, but I just happened to be looking at it. Yesterday it was around, 12 or 14%. And out of that, part of it was capital gains, a return from the equity market, and actually the bond market on a principal basis was slightly lower over those past 12 months. And so just investing for yield we think is a bad strategy. People like to get that income, and the income is good even from the equity market. The income comprises a decent percentage of the return, but to go out there and just invest for income in a very tax disadvantaged manner, I think you're leaving a lot of money on the table. Okay, so back to what we want to talk about here is, well, what are the alternatives to the U.S. Treasury or high quality fixed income, paying 2.5%, locking your money up for 10 years, which by the way, some high quality corporate bonds, especially a little bit further out on the maturity curve in the 6-7 year range, you're starting to see yields breaking the 4% range. In a good diversified mix, you can certainly get into the 3% range these days. So what we see is as the interest rates rise, yes, the value of those bonds that you may own already went down, but the interest, the coupon portion of them is getting higher and higher. And as long as interest rates don't spike up and remain there permanently, what you see is the income is able to catch up with the decline in principal, and at the end of the day, you could actually come out ahead of time. We're working on a white paper right now about other historical times where interest rates have gone up and bond investors were still able to make some money. We're coming up on our first break. When we come back, we'll continue talking about the investing for income.